III, the 2003 Nobel Laureate for Economics. Distinguished guests, ladies and gentlemen, please remain standing for the national anthem. Distinguished guests, ladies and gentlemen, you may now take your seats. Yang berbahagia Tan Sri Leo Mogi, Chairman University Tenaga National, our distinguished speaker, Professor Robert Froy Engle III, Mr. Uwe Morawetz, Chairman of the International Peace Foundation, Yang berbahagia Tan Sri Elias Omar, Chairman of the Asia Pacific Brands Foundation, Yang berbahagia Professor Dato' Insinyur Dr. Mashkuri bin Yaakob, Vice Chancellor, University Tenaga National, Your Excellencies, members of TNB Management and Uniten Management, distinguished guests, ladies and gentlemen, Assalamu alaikum and a very pleasant morning I bid to all of you present in this hall. Welcome to the Uniten Tun Mahathir Lecture Series, an annual event for intellectual discourse and deliberation on issues and global concerns. For your kind information, this lecture is part of the ASEAN-wide program called Bridges Dialogue Towards a Culture of Peace, which is hosted through the International Peace Foundation. It is especially brought to you with a collaboration of the International Peace Foundation and University Tenaga National, Malaysia. Distinguished guests, ladies and gentlemen, before we proceed with the order of the day, I would like to call upon Ustaz Abdul Aziz bin Mat Isa from the Center for Islamic Studies and Civilizations, Uniten, to recite the dua in order to obtain blessings from Allah the Almighty.
أعوذ بالله السميع العليم من الشيطان الرجيم بسم الله الرحمن الرحيم الحمد لله رب العالمين والصلاة والسلام على سيد المرسلين سيدنا ومولانا محمد وعلى آله وأصحابه أجمعين أصبحنا وأصبح الملك لله والحمد لله لا شريك له لا إله إلا وإليه النشور أصبحنا على فطرة الإسلام وكلمة الإخلاص وعلى دين نبينا محمد صلى الله عليه وسلم وعلى ملة أبينا إبراهيم حنيفا وما كان من المشركين اللهم اجعل جمعنا هذا جمعا مرحوما وتفرقنا من بعده تفرقا معصوما ولا تجعل فينا ولا معنا شقيا ولا محروما الحمد لله We glorify Allah and ask blessings on and salute the noble Prophet, his companions and followers. Glory is to you, Ya Allah, and praise is to you. We seek your forgiveness and repent to you. Ya Allah, Ya Rabbal Alameen, let this day, the Unit 10 Tun Mahathir Lecture Series, be the most blessed day we ever saw, the most brilliant ideas we ever taught, the most excellent companions we ever met, and the best time of our existence. Allahumma nawir qulubana binuri hidayatik, kama nawartal arda biduri shamsika abadan abada. Rabbana atmim lana nurana waghfir lana innaka ala kulli shay'in qadir. Rabbana atina fid dunya hasanah wa fil akhirati hasanatan wa qina adzaban nar. Walhamdulillahi rabbil alamin.
Thank you, Ustaz Abdul Aziz. Distinguished guests, ladies and gentlemen, now without further ado, I would like to welcome on stage Yang Berbahagia Tan Sri Leo Mogi, the chairman of Unit 10, to deliver his opening remarks.
Saudari pengacara majlis, Professor Robert Engle III, Mr. Uwe Morawetz, founding chairman of the International Peace Foundation, Professor Dr. Engineer Dr. Mashkuri Yaakob, the Vice Chancellor of Unit 10, distinguished guests, ladies and gentlemen. Welcome to the Unit 10 Tun Mahathir Lecture Series. This year marks the fourth series of this much-awaited program in the university's calendar. We have been blessed with the presence of distinguished speakers in the last three lecture series. Yang Amat Berbahagia Tun Dr. Mahathir himself, the former Prime Minister of Malaysia, launched our first lecture in 2005, followed by technopreneur extraordinary Sir Robin Saxby and Dr. Bob Bishop, the founder and chairman of BB World Consulting Services SAL, a Geneva-based high-tech strategic advisory consultancy. This Unit 10 Tun Dr. Mahathir Lecture Series was established as one of the university's main vehicles for promoting continuous learning among individuals and organizations in the country. With its focus on topics of general but critical interest, the lecture series will hopefully enable the audience to gain helpful ideas and strategies on how to cope with today's ever-changing business and social landscape. Unit 10 is a pioneer among private universities in the country. It is wholly owned by Tenaga National Berhad, a public listed company. The university aspires to achieve national and international standing with the high quality and relevance in its teaching, its research activities, and its engagement with industry, commerce, professions, and regional communities it serves. I'm proud to say that Unit 10 is progressing at a rapid pace and moving from strength to strength to pursue its goal of becoming the benchmark for other universities in all aspects. Backed with a comprehensive quality framework, Unit 10's first sweet success in service excellence was when it became the first Malaysian universities to be awarded the Quality Environment certification for both its campus here and in Msci. Just recently, the Malaysia Productivity Corporation also declared Unit 10 owner of its 2008 Malaysian National Quality Environment Practices. All academic programs at Unit 10 are recognized, not only by Malaysian accreditation boards and professional bodies, but also by those outside Malaysia. This includes the Institute of Chartered Accountants of England and Wales for Uniten's accountancy program, and the Institute of Mechanical Engineering, the UK, for the university's mechanical engineering program. Uniten is the first university in Malaysia to obtain a full 5-year unconditional accreditation for its mechanical engineering degree, which places it at par with the engineering degree in the United Kingdom. In addition, our researchers have also made their mark by winning interest at both local and international levels. As an institution of higher learning, Uniten's role as an educator is vital. This lecture series is a platform for distinguished individuals who have made their mark in the world to share their achievements and life experiences, and we hope through that will help inspire and motivate the community at large, especially the younger generation. Ladies and gentlemen, today at this 4th Uniten Tun Mahathir lecture series, we have the privilege and pleasure of welcoming Professor Robert F. Engle III, who is the Sberigis Bank Prize winner in economics in 2003 in memory of Alfred Nobel. After obtaining his PhD in economics from Cornell University, Professor Engle became Professor of Economics at the Massachusetts Institute of Technology. He then joined the faculty at the University of California, San Diego, until his retirement in 2003. Professor Engle currently holds the positions of Professor Emeritus and Research Professor at the University of California, San Diego. He also teaches at New York University's Stern School of Business, where he is Michael Amelino Professor in Management of Financial Services. He also co-founded the Society for Financial Econometrics. Professor Engle's most important contribution was his path-breaking discovery of a method for analyzing unpredictable movements in financial market prices and interest rates. His statistical models of volatility have in fact become essential tools of modern asset pricing theory and practices. Professor Engle will speak on a topic titled, "Why is Global Financial Volatility So High?" This being volatile times, we are indeed most fortunate to have Professor Engle here this morning to enlighten us and enhance our understanding of and on why is global financial volatility so high. On that note, I would like to welcome Professor F. Engle III to Uniten and to thank him for honoring us with the pleasure of his presence and the wisdom of his expertise and experiences. We would also like to thank Mr. Uwe Morawetz and the International Peace Foundation for making this possible. Thank you very much.
Thank you, Yang Berbahagia Tan Sri, for a very inspiring speech. Distinguished guests, ladies and gentlemen, next I'd like to call upon Mr. Uwe Morawetz, Chairman of the International Peace Foundation, to give an introduction to the second ASEAN event series, Bridges Dialogues Towards a Culture of Peace.
Welcome to the second ASEAN event series, Bridges Dialogues Towards a Culture of Peace. Bridges is facilitated by the International Peace Foundation, a non-political and non-religious foundation under the common patronage of 21 Nobel Peace Prize laureates based in Vienna. The events are hosted in cooperation with various local partners, including the country's major universities. And having started in November 2008, Bridges is being continuously held now in Malaysia and Thailand until April 2009, involving the participation of Nobel laureates from all fields. The second ASEAN series of bridges is an independent contribution to the Decade for a Culture of Peace and Nonviolence, initiated by the United Nations General Assembly. It follows the series of 300 bridges events, which the International Peace Foundation has already hosted in Thailand and the Philippines since 2003. Increasing ethnic, political, religious, and social conflicts and the helplessness to respond to them without further stimulating the spiral of violence show us peace is not a given good. It has to be constantly learned, experienced, and created anew. Peace is not a passive state. Peace is a process which needs time, attention, and the participation of all of us. And peace begins with education. The seeds of peace need to be planted in schools, in universities, in the new generation. This is why the International Peace Foundation cooperates with major schools and universities, as well as with UNESCO, in realizing this Bridges program. We believe in the importance of the education and scientific community of Malaysia by bringing the knowledge and wisdom of Nobel laureates for peace, physics, chemistry, medicine, and economics to this country. What these highly in-demand Nobel laureates normally see of a country are airports and hotels. They deliver their lecture, stay for one night, and leave. We have invited them here not only to speak, but to share, to engage, to listen. They come here not for one day or one event only, but for various dialogues in different parts of the country, without requesting any honorarium, because of their real interest in building bridges, because of their real interest in Malaysia. It is our hope that these are not the first and final visits of these Nobel laureates, but visits with many fruitful returns to build long-lasting friendships and to start, for instance, research programs or other forms of cooperation with the local universities and schools. This is how bridges could develop into a long-term and sustainable success for Malaysia to strengthen education as a basis for peace. I thank Chairman Tan Sri Leo Mogi and Vice Chancellor Professor Dato Dr. Maskuri bin Yaakob, the University Tenaga National and the organizing committee of today's event for taking up this opportunity of our cooperation and for inviting today the 2003 Nobel Laureate for Economics, Professor Robert Engle, to this prestigious university. We look forward to his keynote speech and to his important contribution to build bridges. Thank you very much.
Thank you, Mr. Uwe Morawetz. Distinguished guests, ladies and gentlemen, as Yang Berbahagia Tan Sri has put it most elegantly, we shall now bring you the lecture on global volatility. Please put our hands together and welcome on stage our distinguished speaker, Professor Robert Froy Engle III, the 2003 Nobel Laureate of Economics from New York University.
Well, good morning. It's a great pleasure to be here. It's a great pleasure to be at UNITEN, this very wonderful university. Maybe I should move this. And I'd like to thank Tan Sri Leo Mogi and all distinguished faculty and administrators who are here today and have helped arrange this visit. And I'd like to particularly welcome students and faculty to this lecture. I'd like to talk about a subject that we see all the time. Am I getting an echo? Yes. Perhaps if you turn down the volume just a touch, it would be better. How's that? Is it the same or better? Better. Every day when we listen to the news or read the newspaper, we see that the stock market has gone, well, sometimes up, but often down quite a lot recently. And when we discuss this, what we're talking about is the volatility of the stock market. Volatility is the size of the movements, and if these are large on a day-to-day basis, we say the market is very volatile. And what I'd like to talk about is things like, how volatile is it really? Which stock markets are more volatile? Which other financial markets are more volatile? And why has this happened? And how do we go from here? How do we organize our thinking about the future that's before us? So I'd like to start with just a comment about risk. I'd like to think about this in terms of risk. A risk is some future event, some bad event in the future, which possibly we could avoid. But many risks are risks that we are willing to take because the rewards are great enough to be worth the cost of taking the risk. The systematic study of which risks it's worth taking is one of the major topics of finance, where the risk-return trade-off is a key feature that we study. Is that better? Good. I thought maybe we lost the lights for a second, but I guess we're okay. So this turns out, of course, to be a topic that's been studied for many generations of finance professors, and many Nobel Prizes have been given for answers to this problem. Markowitz and Sharpe and Tobin all received Nobel Prizes for work which associated the risk of a financial market with its volatility. The higher the volatility, the higher the risk. In Sharpe's creation, the capital asset pricing model shows the first answer to the question of which risks should we take and which risks should we not take. And the answer is a very simple one, that we should take only diversified risks. We should form portfolios that diversify as much as possible the risks that we have, and those would be the only risks that would really be rewarded. If we take risks that are not in this form, then we're just gambling. Another development along the same lines is the Black-Scholes options pricing formula. And Myron Scholes and Bob Merton received Nobel Prizes for this. And what the options pricing formula does is it tells you essentially what is the cost of insuring a financial portfolio. If you'd like to make sure it doesn't go down in value, what do you have to pay? That's another way of measuring risk. And what they developed were theories which said that the price of this insurance depends on the volatility of the asset that you're insuring. It's not a very surprising result, but it was a very instrumental development. The difficulty that practitioners faced when they started to use these models was that the variances were not given in a textbook, and when they tried to measure them, they were changing over time. So we have the difficult situation of how do you measure something that is continually changing, and so that you can apply these theories. In particular, for example, what is the volatility today? Or even more important, what's it likely to be in the future? Because if we carry out an investment today, we'd like to know how risky it's going to be over in the future. So we'd like to be able to forecast this volatility. How do we forecast something that we don't really observe? Well, that turns out to be the problem that the Arch model is designed to solve. The Arch model is the model that I created, which sometimes people want to know, where does the name come from? It stands for autoregressive conditional heteroscedasticity. And once you've heard that name once, you don't ever want to hear it again. So that's why we call it Arch. And it relies on two fundamental features of the data. We call them volatility clustering and mean reversion. And what that says, very simply, is that when volatility is high, it's likely to stay high for some time, but then gradually decline back to more normal levels. And when it's low, it's likely to stay low for quite a while, and then rise up to more normal levels. And the econometrics of this problem is to figure out what are the times, how long does it take for these things to happen? What is our estimate of this dynamic process so that we can use past data to forecast future volatilities? Well, this model is very simple, but it has opened the door to a great deal of financial econometrics research and earned me a front row seat in Stockholm 5 years ago. And it's actually 5 years ago on the 10th of December, so that's 2 days ago now. And they have just had the same award for this year's Nobel laureates. And I empathize with them. I remember sitting there in the front row wondering what was in the future. What was this going to mean to me? What was it going to mean to the profession? I never imagined that I would be here in Kuala Lumpur speaking in Uniten in 5 years, but things develop in very amazing ways as a result of this award. But in fact, the audience was not looking at me. The audience, I think, paid a lot more attention to the Swedish royal family. You see the king and queen there, the queen mother, and most prominently, the crown princess. And I think my son was quite taken by her as well. Although it turned out she has a boyfriend. And then the king presents the medal. It's in that little red box. And after it's all over, I receive congratulations from my wife. You see the medal in the foreground there, and Alfred Nobel in bronze in the background, making sure everything happens according to schedule. And it's really my wife. So what is this Arch model anyway? Here's a picture that I think is a way of thinking about it. In the red is every day's return on the Standard & Poor's stock market index from 1990 up to about a year ago. And you can see it goes up and down. And the blue and green curves are predictions of the Arch model. Actually, it's the Garch model, which is a generalization, of what the confidence interval is going to look like on the next day. So if every day someone could tell you the stock market is going to be within this bound tomorrow, that would be a way of understanding how much risk there was in the market. In fact, the green curve at the bottom is a commonly used measure of risk in financial markets called the value at risk, and it talks about how much is it possible that you're going to lose in the market tomorrow. These are calculated as standard deviations, and so this picture is a 3 sigmas picture, plus 3 standard deviations and minus 3 standard deviations. And the dramatic thing you see is that these are not constant over time. That in the middle 90s, the confidence bands are quite tight. In between 98 and 2002, they're quite wide. Then they get narrow again. And of course, on the far right-hand side, you see they're starting to expand. And the question is, what's going to happen next? And I'm going to have to show you in a subsequent slide what happens next. So this way of measuring this gives you an idea what could happen in the next day or so to your position in the financial markets. It turns out that about less than 1% of these days exceed the 3 sigma band. That's a little more than you would expect for a normal distribution, but not more than you would expect for a more fat-tailed distribution like a student T distribution. But you might wonder whether this really works in the kind of turbulent financial market we're in today. And does it really work looking forward, or does it only work when you look backwards over time? So what I want to show you next is that if you take this model estimated through, say, 2004, which is what I did, and then you freeze the model at 2004 level, but every day you use the information that you have to forecast the next day's confidence band, you get a different looking picture. This is the picture starting in 2005 using information only up through 2004. And what you see, of course, is the confidence band is very narrow for several years, 5, 6, and 7. This is the first half of 7 anyway. This is the period of low volatility that we've just come out of. That's really, again, been a global period of extraordinarily low financial market volatility. But starting in the summer of 2007, the confidence bands got wider, and starting in September of this year, they have skyrocketed on the right-hand side, and you can see that these measures of risk have increased dramatically. The money that we have in the stock market is much riskier now than it was 6 months ago, and it was a lot less risky a year ago. In fact, if you look at this, you see that it rarely crosses the 3 sigma event, even though we've had these incredibly turbulent times. And that's because the bands are increasing fast enough so that the events that are so large don't cross the 3 sigma confidence bands. If you look at the returns divided by the standard deviation, it looks kind of like a bell curve and sort of like a normal distribution, although if you look at the kurtosis on the right-hand side, you'll see it's more spread out than an ordinary normal distribution. And if you can look carefully at those statistics, you'll see that the biggest event on the upside is 3 sigma event. And if you look at the minimum, the worst event on the downside is actually 7.5 standard deviations. So a 7 sigma event is extraordinarily big and suggests that there is something in this time period that the model didn't pick up. Let's ask what that is. If you look at this, at the data that's behind this plot, you can see that this one big event is the largest event in this period. Other than that, it looks pretty uniform. And that big event is in February of 2007. And if any of you were managing money in February of 2007, you may remember February 27th was the day the Chinese government decided to tax transactions on the Shanghai stock market, because they were worried that the Shanghai market was having a bubble. It was growing in an unsustainable fast pace, and they wanted to slow it down. The entire world stock markets collapsed that day, but recovered in a matter of a few days. So it was a rather short-run event in the global financial system, but it was very dramatic, and it came at a time when volatilities were otherwise very low. So that's the reason it shows up as a 7 sigma event. The big events of this fall, the Lehman bankruptcy, the bailout that did or didn't happen, interest rate cuts, those don't show up on this. Those, the model seemed to accommodate in stride. So why does this model actually provide such a good explanation for the risk that's being taken in financial markets? In order to answer that, we sort of have to answer the question, why is volatility high? But behind that is the question, what moves stock prices anyway? What makes them change? Right, we all believe this, right? Yeah, my students think this is the answer. But I try to give them another alternative to this, because if this is the answer, then there's nothing we can do about it. So what I think a better answer is that everyone who invests in the stock market is doing it because they think the future earnings of a company or a country are going to be greater than the market expects. And so it's really an evaluation of the future prospects that we carry out when we decide to buy a stock or to sell a stock. And so if this is the case, then volatility is the natural result of people getting new information about the prospects of individual companies or countries as a whole. Volatility then we can see as an essential ingredient of the operation of financial markets. If there were no volatility in a financial market, it wouldn't be able to do its job. There wouldn't be up-and-coming companies that are going to make brilliant new products and become large companies. There wouldn't be old, tired companies that are going to need to deteriorate in their value and their market cap. There wouldn't be banks that are headed for bankruptcy. In any case, volatility is a natural function of the market. And when we say that we're in a period of high volatility, what this means is we're in a period when there's lots of news. And in fact, if you think about it, that's the way it is today. We have news in the newspaper every day, which is amazingly important compared to what we used to have a year ago. We see bankruptcies, we see governments trying to decide whether to bail out one industry or another industry. In the US now it's automobiles, but maybe airlines are waiting. It's been the banks. We see signs of slowdown in Singapore, in manufacturing, in a variety of, Malaysia. This morning's paper was full of bad news about the Malaysian economy. So there's just a lot of news every day, and financial markets are responding to news by moving along the way. So in a simple sort of sense, volatility is because there's a lot of news. It doesn't exactly help us, but it helps us understand where the volatility is really coming from. It's people doing the best job they can of figuring what the future is going to really look like. There's another feature which we can extract from this way of thinking about it, which I call asymmetric volatility, which is the fact that bad news moves markets more than good news does. And that is sometimes described as a characteristic of fear and greed or something like that. But I think it can be just described as a characteristic of risk aversion. We don't really like stocks that are risky. And so if a stock becomes riskier, we're likely to hold less of it. And so you would expect the value of this stock to go down when it becomes riskier. And so changes in risk for economy as a whole or an individual stock are likely to be associated with a drop in price. So prices falling and volatilities rising are often reflections of the same information. So we tend to see high volatility when markets are falling, and bear markets are a time for especially high volatility. And that's, again, where we are today. In fact, there might be other risk factors that are important for pricing the assets that we look at. And these risk factors are described by the intertemporal capital asset pricing model as factors which change the future investment opportunity set. That is, they're factors which tell you that the future is going to be better than it is today, or that's going to be worse than it is today. And factors that are associated with that would have value for investors in hedging their long-run risks and for understanding what they're going to look like. In fact, such risk factors should also carry a risk premium. And when these risk factors become more risky, we would expect them to be less desirable, so we would see decline in value. So we can actually test whether some factor that is considered to be a risk factor does have these risk characteristics. We can estimate an asymmetric model for these factors and see whether it's true for these as well, that negative news is associated with rises in volatility. So at the risk of putting you off, I'm going to show one slide, which is an empirical estimate of what's really a Garch model. It's an asymmetric Garch model. And in the first column, the volatility that we expected today. So if you look at that model and then do the same model for other hypothesized risk factors as so-called Fama French factors, which are proposed by Jean Fama and Ken French in a whole series of papers. There's a size factor. This is for small cap stocks. There's a book to market factor, which is for value stocks that look like they're good value versus stocks that may have growth potential. And you look thirdly at momentum stocks that have previously gone up, past winners versus past losers. You see that all three of these factors have some evidence of asymmetry, but it's of the opposite sign. It says when these factors become riskier, people seem to buy more of them. So they're probably not really risk factors. They may just be statistical factors that people found in the data, and they might not really continue to be relevant for investing in the future because they're not really associated with natural risk. But there might be other factors that we're going to come back to. It could be volatility itself is a long-run risk factor. When volatility goes up, the investment opportunity set gets worse. That's what we're seeing. And so it might be that volatility is one of these hedge factors. We're going to talk about war and terrorism as a long-run risk factor, and we're going to talk about climate change as a long-run risk factor. But before we do that, let me show you a few pictures of what volatility is doing now. And these are pictures actually done through last week. December 2nd, I guess, was the observation. And these are from a website that we've developed at New York University to update volatility models on a daily basis and make them available to the general public. It's called VLab because it's the Volatility Laboratory. So we're testing out volatility models and seeing how they actually work in real time. So here is the S&P 500, and you see the same sort of results we've seen before, but I want to draw your attention to the far right-hand side of this curve. First of all, where there's a scale which shows that typically it's between 10 and 20% volatility. In the bad times around between 1998 and 2002, we had volatility which was more or less between 20 and 40%. But we have just over the last month and a half, or I guess or 2 months now, seen volatility spike up to the 70 and 80% level. This is extraordinarily high volatility that we've not seen since 1990, and we'll have to take a look at whether we've seen this before at all in the US history. Volatility of 70% corresponds to a daily standard deviation of about 5%. So a 5% standard deviation, if we think about this 3 sigma confidence band, that says we're pretty sure that the financial markets are going to be within 3 sigma on the next day. So that's 3 times 5%. That would be 15% up and 15% down. And almost every day we're pretty sure that we're going to be within plus or minus 15%. Well, that's a pretty big interval. The stock market falling 15% in a day is an amazing event. So that shows you what a big volatility we're really talking about here when we're at 70%. So here's a shorter picture. This is just since, I guess this is what, 6 months of it. And I've plotted it against the VIX, which is the volatility estimated from options markets. It's a totally different data source. And what you see is they really move pretty much together. In fact, even the wiggles are pretty much lined up together. And that's a result of this asymmetric volatility being present in options prices as well as in the Garch models. If you look at exchange rates, you see that although they were on average about a 10% volatility, in the far right-hand side, the yen dollar and the euro dollar exchange rates have had volatilities that have risen very dramatically. The euro dollar going to 20% and the yen dollar going up to almost 30%. If you look at the MSCI World Index, so this is an index of stock markets all over the world, you see volatilities with very much the same pattern. Low in the 90s, low in the 2000s, middle 2000s, high in between. There's probably a little more volatility in 97 and 98 than we saw in the US, but we see this big spike at the end. If you look at an emerging market index, you see volatilities about a month ago were almost up to 100%. So 70% is high, 100% is higher. But we see this interesting trend that volatility has fallen very dramatically in the last couple of weeks. Now, this is only through December 2nd. So I'd like to see, I was actually hoping that I would be able to show you up to even yesterday, but I didn't get it done. In any case, this has shown a very substantial decline in volatility, which if it lasts will be very encouraging for investors in emerging markets. Looking at Asian markets, we see that Australia, Hong Kong, Japan, and Singapore all have roughly similar patterns of volatility, rising dramatically in September. Hong Kong seems to cross the 110% level, whereas Japan only gets to maybe 90%. They all are showing some evidence of decline at the end. If you look at sectors in the US, you see in red the high-tech sector, which was the main affected sector in the internet bubble of 2000, and you see its high volatility on the left-hand side of the graph. In the middle, you see the energy sector, which moved dramatically as oil prices shot up to $147 a barrel, and of course now dropped back down again. And on the right, you see in blue, the highest volatility is in the financial sector, where it hit 130% recently, as the banks have come under incredible selling pressure, and the government has had to decide whether and which banks to support and whether to let them fail or be purchased. And finally, you can look at correlations between these sectors. And the red curve on here is the average correlation across all pairs of sectors in the US. But then there's some specific ones shown on there. The black and the yellow are the correlations between energy and technology and energy and financials. And what you might be able to see is that these were actually negative in the last summer. They seem to move in opposite directions. Some people think that may be associated with long-short hedge fund strategies that were often short financials and long commodities and energy. But at least they were moving in opposite directions. Some sectors were doing well when others were doing badly. But starting in September, these correlations rose, and now, when we get to the end of the sample period, they're all together. So the different sectors of the US economy, which had some strengths and some weaknesses, exports were doing well, housing was doing terribly, energy was doing well, financials were doing terribly, but now we're all doing the same. And it's down, unfortunately. And I haven't done this for countries, but I suspect we might see something similar in countries, that the financial markets in different countries have been very differently impacted by this financial crisis over the last year, but at this point in time, we're all in it together, I'm afraid. So, in summary, for most assets, volatility is now dramatically above the levels we've seen since 1990. What are the causes for this? There are two causes I'd like to propose here, one of which I'll talk about a little bit. That is macroeconomic uncertainty. The second one we could talk about in questions, if you'd like, which are the credit problems, particularly associated with securitized debt, subprime crisis, CDOs, over-the-counter trading, bankers who take too much risk, and that sort of thing. So those have actually contributed a lot to volatility, particularly in the financial sector, and now I think in the macro economy as a whole. But I think it's more useful to think about the macroeconomic determinants. So let me show you very briefly a study that Gonzalo Rangel and I did, published a year ago. I guess it's this year, actually, which was designed to try to figure out what are the macroeconomic events that are associated with financial market volatility. So what we did was we estimated one of these Garch models, but a sort of a special kind of Garch model, which had for 50 different countries. And we looked at where these volatilities were high, which countries had high volatility and which countries had low volatility, and which time periods had high volatility and which time periods had low volatility, and what was going on in the countries at that time, to try to figure out, can we associate some characteristics with high volatility? Well, in short, what we found was that countries and time periods with high inflation had high volatility. We found, perhaps more importantly now, that countries with slow output growth and recession had higher volatility. Also important now, high volatility of short-term interest rates led to high financial market volatility. So the short-term interest rate is actually a policy tool usually set by the central bank, and central banks have been dropping short-term interest rates very rapidly. But this is actually one of the features which is associated with high volatility, and it doesn't mean they shouldn't do it. It just says this is partly an explanation for why volatility is high. Similarly, if output growth is very uncertain and volatile itself, or inflation is uncertain and volatile, we see higher volatility. It's also true that the less developed financial markets are likely to be more volatile, everything else being equal. Although the difference between emerging markets and developed markets in terms of volatility is largely explained by these macroeconomic effects that I've just described. So, were we ready for this? I mean, a lot of the macroeconomic turndown was predictable. The economies had been growing. We were, of course, worried about inflation up to maybe 6 months ago when energy prices were still so high. Now we've decided inflation is not what we're worried about. Maybe it's deflation that we're worried about. But the macroeconomic slowdown has been predicted for a while. The risks to the global economy have been apparent to many people. So were we prepared? Certainly not all of us were, because many of us have lost lots and lots of money in the stock markets because we didn't see this coming, at least at the extent it came. So let me now take you back in time a little bit to see whether this event has any historical antecedents. Here's a picture of the Dow Jones over the last 80 years, starting in 1928. Anybody remembers 1928? I don't think so, but we all read about it because 1929 was the great stock market crash, and that was one of the major events in economic history for a long time. I think what we're going through today is going to be one of the major events in economic history that we'll study for the next decade. And so we should pay attention because it's very interesting what's happening, and it's easier to think about this as a science project than to think about it like this is this world disaster. In any case, we have back here at the beginning on the left-hand side of this picture the high volatility of the 30s. You see the enormous price move that happened in 1987 with the stock market crash. You see the high volatility period of the internet bubble and probably the Asian currency crisis there. And then on the right-hand side, you see just up against the border the high volatility we're in today. So let's take a look at what the volatilities actually look like in this period. Using sort of a Garch model over this entire sample period, we can get estimates of volatilities over these different intervals. So you can see in 1929 this enormous spike in volatility when the stock market crashed. Volatility went up to 100%. We now know how that feels. But it was only for a short amount of time. It decayed quite rapidly back down to about 20%, and then gradually, slowly increased, reaching maybe 50% for several years, maybe from 31 through 33 or 34. So this was the end of the Hoover administration and the beginning of the Roosevelt administration. Roosevelt brought in, Hoover treated the recession as if it was a time when the government should contract and not defend the banks. Roosevelt treated it as a time when the government should employ massive fiscal policy to hire unemployed workers and put them into work doing things which were good for the economy, and put in deposit insurance and various protections for investors and banks. These were untested theories, proposed in many cases by Keynes, but this was a brand new theory that Keynes had proposed and was extremely controversial. And I think the financial markets had no idea whether it was going to work or not. We think in retrospect that it did work, but some substantial amount of this high volatility was presumably because these were untested policies and we didn't know what was going to happen, so that the policy itself contributed to the volatility. And I think we're there today as well. The policies that we're using in the United States are untested. The investments we're doing in banks, this bailout bill that we've got, the car czar that people are talking about to try to help the automobile industry recover. These are untested policies, and financial markets are very nervous, and they don't know whether to go up or down when they see these kinds of policies. There was a spike in volatility in 1937, so it rose back up again. I assume that's probably due to the war in Europe having started and the US being nervous about it, but I'm not exactly sure. I was also told that's when Roosevelt tried to reform the Supreme Court, so to get more of his policies through. What happened in 1987? Volatility spiked up to 140, but it didn't last any time at all. In fact, this event is so short-lived, it had no macroeconomic implications, and it's often attributed to portfolio insurance, which allowed investors to think that they had protection for their portfolios when, in fact, it was really not there, so that maybe people took more risk than they expected to take, and as a consequence, when it was time to sell, everybody tried to sell at the same time, and the market fell dramatically. So what can we expect now? Where are we in 1998 to 2008? I'm not sure whether any of you have been to New York, but in front of the Merrill Lynch building, there is a giant bronze bull on its feet. But of course, Merrill Lynch is not. Merrill Lynch has been basically purchased by Bank of America, and it's not clear whether the bull is dead or not. But that's a pessimistic view. Possibly a little more optimistic is Barack Obama dancing with Sarah Palin. We're not sure whether we'll be dancing in the near future, but anyway, what do we see when we look at the data? Well, we've already seen this picture, and what we don't know is what's on the right-hand side. We don't know how much of this volatility is due to the markets adjusting to the new lower expectations for the global economy, how much of it is a result of these innovative public policies, the short-term interest rate fluctuations, which the government, I think, has probably rightly done. What's going to happen next? That's the question that we'd all like to know. You know, if you take these models seriously, they would say it's probably going to last for a while. The Garch forecasts would show a gradual mean reversion, but that would tell you that the mean reversion is going to last. It's going to take probably a year or two before it comes down. I'd prefer to think about it in terms of the macroeconomy, and the study of Gonzalo and I did, where it's really the recovery of the macroeconomy that we're waiting for. When macroeconomic uncertainty is resolved as to what the economy is really going to do, then the financial markets will not be so volatile. And the question is, how long is it going to take us to know whether the macroeconomy is stabilized? I think it's going to take a while. We don't know how bad this is going to be. Financial markets have a forecast. If there is more bad news, then the financial markets are going to have to fall. If there is some good news, then financial markets will go back up. And as long as this news is churning, then maybe there will just be volatility without a direction. But if there is substantially more bad news than people are actually expecting, then they can fall some more. How about the Kuala Lumpur stock market? So here's a picture of the Kuala Lumpur market since 1993. You see in blue the level of the stock index, which fell dramatically in 97 and 98, and then fell again in starting in more or less January of 2008. And of course, in the top you see the volatility. And when you estimate a Garch model, which I did in the hotel room the other day, you see volatilities were low in 2004, 5, and 6, like in the rest of the world. We had a spike in early 2007, which I think is the same event. And then in the first quarter of 2008, there is the biggest spike on this graph, which I believe is the election and the uncertainty that the financial markets felt about what the future was going to hold, both probably before and after the election. But you don't see this big spike on the right-hand side that you do for most of the other assets I've looked at. And so possibly that's because the market fell a lot in March of 2008, so it didn't have so much really to go this time. Or perhaps it's because Malaysia is a little more insulated from some of these crises. Hopefully that's the case. So in any case, I just thought you might like to see what that looks like. If you look at the whole picture together, you see this recent episode is dwarfed by the 97, 98 crisis, where volatilities briefly exceeded 200%. So that's a big number, as we now know. So I've analyzed, I'm supposed to be done. I've analyzed in some substantial detail what the volatility looks like in different parts of the world recently. And when we look at these volatilities, what we're talking about is really short-run risk. We're talking about what kind of risks we're likely to have in the near future, but it doesn't tell us really very much about what's likely to happen in the long run. And it's important to look at long-run risks as well. And I want to just tell you quickly about two long-run risks that I'm worried about. The first is the risk of war and terrorism. And the reason I think we should worry about this is because as the global economy is deteriorating, and as income differentials between rich and poor countries seem to be increased, and fundamentalism in many parts of the world is increasing, I think the risks of war and terrorism will really increase. And what is the effect of this on financial markets? I mean, normally we talk about the effects of war and terrorism on us in lots of ways, but we might not talk about the financial markets. So let's talk about the financial markets. What happens is if there is a bigger risk, investors are likely not to invest as much. The bigger the risk in the long run makes it a less attractive asset. So the equilibrium price is lower. So if the long-run risk of war and terrorism reduces the value of the stock market, then that is going to increase the cost of doing business. It increases the cost of raising capital. It reduces the income of entrepreneurs, and it costs us jobs. So these are current costs of this sort of long-run risk. What can we do? Well, it sounds simple, but in fact it's not. How do we promote peace? I mean, there are many things that can be done to promote peace. We can approach it through politics, science, medicine, culture, education, and law. We can approach it through the very important work that the International Peace Foundation is doing, such as bringing lectures to talk about peace and the ways to peace. We can talk about it in our educational institutions. There are many, many solutions, and I don't want to talk about what I think is going to be the best or the worst of these. I'd like to mention a couple of economic proposals that I think are important. I think trade between countries is an important way that they become interdependent and therefore are less likely to be willing to go to war. Capital flows, economic interdependencies in general are ways of avoiding the risks of war. I think fighting poverty is a way of avoiding the pressures for terrorism. And I think reforming education to show the values in cooperation and tolerance is a really key ingredient. And I think that the universities have a very important role to play in this kind of argument, that we need to show the benefits of cooperation. We're in a global economy. We have to cooperate with each other, and the benefits from cooperating are enormous. The costs from not cooperating are what we're talking about here. Peace permits prosperity. Without peace, we can't have prosperity. We can't do our business. We need to have stability in our governments. We need to have stability in our political relations with our neighbors, with our economic relations with our neighbors, and that lets us do the best thinking and our best kinds of business plans, and that's where jobs and income come from. So if we can reduce the future risk of war, we will have benefits today by improving business and stock market valuations and creating jobs. Just reducing the risks have benefits. We don't have to eliminate war, we just have to reduce the risk of war. We just have to reduce the risk of terrorism, and that will have a benefit. This is not an impossible task. This is just something that we should do. Well, I think you can tell a similar story about the environment. If the environment gets worse in the future, we're going to end up having to spend lots of money to fix the environment. We're going to find our businesses are spending money to fix their physical plan and adjust their products and so forth to a new, warmer or more turbulent global environment. And consequently, this is also a long-run risk which impinges upon us today. But it especially impinges on the young people here who are going to be the workers in 20 years who have to pay these costs and are going to find that potentially the globe is less able to support the standard of living that we're expecting. In the US, we're also worried about unfunded public pensions. And so what most economists think the easiest solution to the climate environment is to put a tax, a comprehensive tax on carbon emissions. And if you do that, then it will encourage alternative energy solutions. They don't have to be subsidized. They will be encouraged by the relative price. And if it's comprehensive, then we can be happy when anyone manages to avoid this tax because they're doing exactly what we want from a green point of view. High oil prices encourage us to economize, and we can see this very dramatically in the US over the last couple of years when we had such high gasoline prices. We saw a very substantial change in the behavior of Americans. Politicians, however, think this is impossible, but I think that's because they don't pay attention. They only pay attention to the costs of a tax. They don't pay attention to the benefits of a tax. And if you think about the revenue that comes from this tax, the question is, what do you do with this revenue? That's the good news. The tax might be the bad news, but the revenue is the good news. So suppose you take all this tax money, which would be a lot of money, and you divide it by the number of residents, and you send everybody a check. this might look like a pretty good idea then, because you're going to be taxing everybody based on how much energy they use, but you're going to pay back this large amount of money to individuals. And so they could take this check and use it to buy fuel-efficient cars, move closer to their job, get a bicycle, whatever is necessary, so then they don't actually have to pay the tax either. They just get the benefit. Eventually, of course, we won't be in a recession, so it would make sense to use this for other purposes, and I would propose putting it into a sovereign fund the way some of the forward-looking oil countries have done to fund future social needs such as the retirement need in the US. In this case, we're taxing a bad rather than a good. We're taxing emissions rather than labor income, and that's a good outcome. So let me just conclude by showing you a picture here. This is you might think of this as a prospectus for an investment. This group of people wants your money. And you look at them and you say, does this look like a promising enterprise? Would you put any money into this group of individuals? It doesn't look too good to me. I mean, I would be very suspicious if someone came to me and said, you know, why don't you put some money into this? But in fact, if you look carefully, you'll see in the lower left-hand corner, there's little Billy Gates, who is the richest man in the world, or at least was until, I don't know, 6 months ago or something like that. And what it turns out is this is the Microsoft team picture in 1978. So that's 30 years ago. So here's Microsoft, one of the biggest corporations in the world, as a startup 30 years ago. Now, of course, I'm sorry I didn't give any money in 30 years ago. And we're all sorry we didn't do that. That would have been a brilliant investment in spite of this picture. But it does suggest what can happen in 30 years. 30 years can go by amazingly fast. And if we can start on some of these peace initiatives or some of these climate initiatives, in 30 years we would have accomplished a great deal. And I think we would be able to look back on it and say, you know, that was a really wise investment we did 30 years ago. And it would have yielded benefits all the way along, and we would have basically made a very big improvement in the world we live in. So that's kind of my conclusion. Let's make sure we only take the risks we intend to take, keep an eye on the long-run risks, and remember that reducing the long-run risks has benefits today. And in case you have a hard time sleeping, here's a book you might want to take a look at, which isn't out yet. It'll be out next month, called Anticipating Correlations, and it's talking about how you do risk management and how you forecast volatilities and correlations in these kinds of turbulent times. So come join me in my favorite cafe, the Arch Cafe. Thank you.
Thank you, Professor Engle, for such an enlightening and mind-blowing lecture. We'd appreciate it if you could remain on stage to answer a few questions from our members of the audience. Thank you. Distinguished guests, ladies and gentlemen, we shall now proceed with the question and answer session. We seek your cooperation to use the microphone in order to enhance clarity and audibility. Also, please mention your name and institution. I shall now invite the first question from the audience.
Hello, my name is Liang Ng from University Malaya. I think this is a philosophical or maybe even a practical question, which I have asked several Nobel laureates in the past. Do you believe that in your lifetime or maybe in our lifetime, science will progress to a sufficient level to achieve technologies which enable us to become immortal or live much longer than we are? And if so, would you spend your money and time towards that so that you can live much longer than you have all the time you have to pursue other interests?
You know, I get asked a lot of questions about my forecast of the future, but I've never been asked that one before. You know, I don't know. We're obviously making progress on understanding what makes people live longer. I don't think we're going to find the magic elixir that makes us live forever, and I don't know whether that would be good, would it? But in any case, I don't have a special answer for that. I'd like to know the answer. How about another question?
Hello, my name is Jonathan. A very good morning to the chairman of Uni 10 and to all his wonderful colleagues here at Uni 10 and to everyone in this room. Good morning to Mr. Uwe Morawetz and also to you, Professor Robert Fry Engle III. Welcome to Malaysia. Professor Engle, I read your autobiography. My dad used to wake me up in the morning to go on an adventure with him, just like yours. In the last few years, he has asked me to go forth, experience my own adventures. Adventures without him are lonely and grey at times. Anyways, I have 4 questions for you, Professor Engle.
Could we narrow that down just a little bit?
I know today's topic is on finance. However, the heading is Bridges, Dialogues Towards a Culture of Peace. I hope my questions about peace will be okay for your specialty, or maybe it could be directed towards Mr. Morawetz as well. Question 1. Does economic stability within the world or in a country have a direct effect on peace within the country or between countries? Just let me repeat.
Why don't you give all 4 of them first?
Just let me repeat. Does the economic stability within the country or in a country have a direct effect on peace within the country or between countries?
So is that your question?
Yes.
Or are you going to ask 3 more?
Yes. Thank you.
Thank you. If you're finished.
I still got 3 more.
No, you're going to have to just
Okay.
decide which question you wanted to ask.
Okay, I'll ask this one then.
You'll have this one.
Thank you.
I think it does, actually. I think that dissension and debate and disagreements are an important part of figuring out what the right course is for a country. But I think ultimately stability is a key determinant for prosperity within the country, and I think will make it much easier for this country to have peaceful relations with its trading partners. So I do think that, I don't think this is a justification for reducing debate, but I think it's a justification for debating as seriously as you can, and when there's a consensus, you go with that consensus, you let it happen, and you move on to the next challenge. We're in a world where we don't have a lot of room to make mistakes because the economies of the world are pretty perilous right now, and it's very important that we have a global, unified point of view on this, that we
might be the Malaysian government have put in place measures such as strengthening our banking and also financial sector, so that it is actually that we learn from our previous financial crisis. So this actually have an effect where that means our market is not as bad as others.
You know, I'm not an expert, of course, in the Malaysian economy, so I can't really comment on that directly. But it does seem to me that there are various ways various countries have tried to insulate themselves from the global economy. I'm particularly cognizant of some of the Chinese arrangements, a lot of currency controls and capital controls, which I think are related to some of the controls that Malaysia successfully used in the 97-98 crisis. And we're all looking with a great deal of interest at what happens in China. There seems to be a lot of pressure on China that the growth rates are dropping, although I don't know whether people are predicting that they might actually go negative and there might be a recession, but that the growth rates in China seem to be dropping. And I think that in Malaysia, what we've seen is that the volatilities don't seem to be as high, but the stock market still fell a lot. And it fell, but I think it fell over a longer period of time, so it didn't lead to as much volatility. And so what investors are always doing is trying to figure out what's the stock really worth relative to its future earnings. And perhaps what we're seeing in Malaysia is that that adjustment has pretty much taken place, that the Malaysian economy has whatever relations it has with its trading partners, which are very important because Malaysia exports goods all over the world. But if you make a forecast as to what's going to happen to trade, and you say, well, it looks like the stock market is 20% overvalued, and once it falls 20%, you can sit there with low volatility waiting for this recession to actually unfold. I think that there's going to be pain here as well. And I hope it's true that Malaysia has insulated itself from this global recession, but my guess is that it's going to have some amount of suffering, maybe less than its neighbors. Okay.
Hi, good morning, Professor Engle. My name is Ahmad Rafdi. Just got a few questions. I'm actually interested in quite some time in sovereign funds, which has become a major talk of the town in the US, especially for the past couple of years. Some economists argue that sovereign funds can create some instability in the macroeconomics, but at some point, I do see that the sovereign funds can contribute a lot, especially to the in terms of social benefits into the country. But what happened was that the sovereign funds that coming in from the oil-rich country, especially into the US, has been kind of controversial in the US, if I'm not mistaken, somewhere this year or last year. So can you please comment on your part on what is sovereign funds can bring to the US and also to the world, especially.
I didn't get all of that. Did you say sovereign funds?
Yes.
So what is the US response to sovereign funds?
Some people in the US are not very keen, especially those coming in from the oil-rich countries, because they thought that might taking away their sovereign and whatnot. So can you care to explain that?
I just wanted to make sure I was answering what you asked. Okay. Yes, I think there is a mixed set of opinions on sovereign funds. We're very happy to have them come in and help support our banks when they're in trouble, but we don't want them to buy our ports because they might mismanage them or something like that. And I don't suppose that feeling is going to actually completely go away, because there is a concern about whether there is a political agenda associated with some of these purchases. On the other hand, this is the way the world is, and if the US is exporting all these dollars to buy petroleum, what we expect in return is that these dollars are going to come back and buy US assets. That would be the natural thing. We're basically selling some part of American capital to pay for our oil. And so I think it's perfectly appropriate for these funds to buy U.S. assets. In many cases, I think it would be more attractive if they bought them in a more passive arrangement. So, for example, buy diversified portfolios rather than buying controlling interest in one company or another company, so that it would be less of a political issue. But I don't think there would be any issue, really, if a sovereign fund ended up owning a widely diversified portfolio of U.S. companies. And I'm sort of surprised, well, maybe they're doing that. I'm sort of surprised that's not the actual investment strategy, because it seems like that's the sensible one to do, and it's supported by economic theory. And in fact, most of the academic work says it's pretty hard to beat that kind of a portfolio.
I'm Raisha
Yes.
from University of Malaya. Prof. Engle, it's a great pleasure to have you here. I have two probably simple questions for you. Okay, based on your slides, you showed that you did make there's this kind of predictions on volatility for the 2008 based on the 2004 models there. So if we have done it in 2002 probably to 2004, how much has this information really been taken seriously before, you know, the 2008 Great Depression developed? That's number one. Number two is slightly more technical. I just want to know from your expertise, how much confidence do you have on the recent developments of arch models, for example, things like robust arch, robust Garch, and so on? Right, thank you.
So the first question is, was this 2004 date that I chose particularly important? And I think the answer is no. I think the parameters are pretty stable over time. But what, of course, the information that's incorporated every day is the recent past, as well as the parameters tell you how to weight the recent past. And so if the parameters are constant over time, then you weight the recent past in your forecast of future volatility every day going forward. And so it wouldn't really matter very much what period you estimated it up to. If you estimated it up through 2002, so you didn't have any of the low volatility period, it probably would mean that the volatility estimates were slightly higher, but I don't think you'd actually be able to detect the difference on this picture. There are lots of kinds of arch models. There are robust arch models. There are arch models that allow for time-varying skewness and kurtosis. There are models which have much more sophisticated versions of asymmetry in them. I think that whenever you look at a financial sector, you can find a best arch model for that sector, which won't always be the same. And so that there is room for better and better models of different sectors. On the other hand, the improvements are not large compared to going from no arch to an arch. So I'm not sure how much better financial decision making we would make by using the best model that anybody can find versus just a good model. I think that there are a couple of innovations which really are quite important. One is this asymmetric model, which I think is so dramatically supported by almost all asset classes except for exchange rates, which are more symmetrical. And the second is the fat-tailed error distributions, which may be what you're thinking about with the robust models, that the T and generalized exponential distribution tend to be much better representations for the data than the normal distribution, even though everything I showed you was actually a Gaussian likelihood model. But I think that there is continuing research in this direction. my personal feeling is that the most interesting questions now are, what are the economics of these volatility models? They're basically statistical models, but we want to know, how do they really work? What do they tell us about the economy? What are these news features that I've emphasized? What are the long-run risks that I've emphasized? How do those affect the volatility models that we estimate, and can we really see those features in the models? And you know, I think that's a pretty interesting set of things to investigate.
Yes, good morning, Prof. I have recently watched a documentary video called Money Masters, and according to the video, that the global financial volatility, basically what is behind all this volatility is actually because of the group of bankers, and all this history has been starting from during the age of Rome, where all this money changes and start to come from the goldsmith, and now we have these modern bankers which they try to manipulate what we call the fractional reserve system, where they have this, with this they have limitless power, and they can manipulate the economy through this inflation and then deflations. I mean, that sort of theory, what is your comment on that? Thanks.
Well, I don't think I buy into that theory, but it's a very different tradition from the tradition that I think describes the world we see. I think that the financial sector, with all its failures and problems with banking and banks taking too much risk and so forth, I think this financial architecture, we should point out, has had enormous benefits for the global economy. I think if we look at the last decade, we see countries like India and China, which were very poor countries 10 years ago, now are major economic powers. Brazil has done dramatically. I think Southeast Asia has grown dramatically over this period. And in the US, the same thing has happened, and this famous subprime crisis actually is associated with loans that are given to low-income people to buy houses. So the question that I think we are faced with when we try to design global regulatory architecture is, how can we preserve the kinds of growth that we've achieved with these kinds of financial systems, venture capital that can find entrepreneurs in small corners of the earth, because the financial system is liberalized. How can we preserve those benefits without having the instability that we see today? And I think that requires a better regulatory architecture, but it doesn't really require such heavy regulation. It depends, I think, more on coordination and stabilization over the business cycle. So I'm optimistic that some of the new initiatives that are being proposed will, in fact, be able to walk this fine line between improved stability of the financial system without eliminating its benefits for the global economy.
Well, Professor, ladies and gentlemen, perhaps we can now accept the last question as we are coming to the end of the event. Thank you.
Thank you. With all this knowledge, Professor Robert, of tomorrow's market, I suspect you're a billionaire by now. If not, are you going to start a string of cafes in Asia? I mean, that might do it. How large is the American market compared to Malaysia's? How many times larger? 1,000 times? Or, do you know?
I don't know.
I just want to make a comment before I sit down. That is, right now we are in a high-risk period, as you would call it, because of two things. Firstly, we do not have, at this point in time, an action plan to deal with the present crisis. Secondly, we do not even have an action plan to create peace on this planet. The answer lies, quite appropriately, Dr. Morawetz, in your name. You and we, working together as peoples of the planet, not races, not religions, not friends or arch foes, but as fellow human beings. And final comment is a flyer. I have a flyer here which says, I received this with the papers here only yesterday, prosperous times are back. Isn't that wonderful? It's McDonald. Thank you.
Well, I certainly agree with most of what you said. I do want to remind you that I am an academic also. I'm not a academics aren't billionaires. But I do think we need to plan for peace and financial stability. And it's a global problem, and I'm optimistic that the United States will be a full participant in this planning process going forward. I think that's something we have to look forward to. I don't think it's going to be an easy process, but I am looking forward to its happy resolution.
Thank you, Professor, for sharing with us your knowledge and expertise.
Good. Thank you.
Now I'd like to invite Yang Berbahagia Tan Sri Leo Mogi to present a memento to Professor Engle. Thank you, Yang Berbahagia Tan Sri and Professor. Distinguished guests, ladies and gentlemen, now we'll have a pleasant surprise for Professor Engle. Without further ado, I'd like to invite Ms. Chu from the Asia Pacific Brands Foundation to continue with the next event, which is a special award presentation by the Asia Pacific Brands Foundation to Professor Robert Fry Engle III in recognizing his contribution in the area of economic sciences.
Salam sejahtera. Yang Berbahagia Tan Sri Leo Mogi, Chairman of Chairman of Uniten, Yang Berbahagia Tan Sri Elias Omar, Chairman of the Asia Pacific Brands Foundation, Professor Robert Fry Engle III, Yang Berbahagia Professor Dr. Engineer Mashkuri Yaakob, Vice Chancellor of Uniten, distinguished guests, ladies and gentlemen. The Asia Pacific Brands Foundation is a not-for-profit organization dedicated to the promotion and improvement of branding standards in Malaysia and the Asia Pacific. Its aim is to honor brand excellence aided by best practices and a strong brand culture. The APBF initiated the Brand Laureate Brand Personality Awards to outstanding individuals who have contributed significantly to the industries that they specialize in. Through their contributions, our lives and the world at large have been enriched. Outstanding individuals who have been conferred this award are Dr. Everett De Bono, the creator of Lateral Thinking, Dr. Myron Vance, the founder of Usana Health Sciences, Sir Cliff Richard, and in Malaysia, corporate captains such as Yang Berbahagia Tun Ahmad Saji, Chairman of Permodalan Nasional Berhad. Today, the APBF is pleased to confer the prestigious Brand Laureate Brand Personality Award to an illustrious gentleman in this hall. It is an honor for me to be given this opportunity to read the citation. Ladies and gentlemen, Robert Fry Engle III majored in physics and graduated with a master's in science from Cornell University. However, a small event happened in his senior year that would have great consequences. He decided to try introductory economics instead of taking one more elective in physics to finish his course. The introduction to economics was the catalyst that changed the course of his life, and he graduated with a PhD in economics from Cornell University in 1969. This was the start of a very enriching journey in the field of economics for Robert Fry Engle, culminating in winning the Nobel Laureate Prize for Economics in 2003 for developing methods of analyzing economic time series with time-varying volatility. Professor Robert Engle's background in mathematics and science proved invaluable as it enabled him to develop economic tools to analyze the unpredictable movements in financial market prices, interest rates, equities, bonds, and derivatives. The science fraternity lost a great son, but it was the gain of the financial and economic fraternities. In today's economic environment, Professor Engle's method of evaluation and forecasting of risks are crucial in helping to stabilize the financial market volatility. Ladies and gentlemen, today in this great hall, the Asia Pacific Brands Foundation, in collaboration with UNITEN, is honored to confer the Brand Laureate Brand Personality Award to Professor Robert Fry Engle III for his contributions in the field of economic sciences. In the same token, we hope that Professor Engle will be proud to receive this coveted and prestigious the Brand Laureate Brand Personality Award, another laureate to his prestigious Nobel Laureate Prize. Now, may I call upon Yang Berbahagia Tan Sri Leo Mogi, Chairman of UNITEN, and Professor Engineer Dr. Mashkuri Yaakob, Vice Chancellor of UNITEN, Yang Berbahagia Tan Sri Dr. Elias Omar, Chairman of the Asia Pacific Brands Foundation, and Dr. K.K. Johan, CEO of the Brand Laureate, to come on stage. Ladies and gentlemen, it is an honor for us to present the Brand Laureate Brand Personality Award to Professor Robert Fry Engle, and may we have Tan Sri Elias Omar, the Chairman of the Asia Pacific Brands Foundation, to present the award. May we have a round of applause for Professor Robert Fry Engle. And also Tan Sri Leo Mogi to present the certificate to Professor Engle. A round of applause for the gentleman. And now we'll have Dr. K.K. Johan presenting the coffee table book to Tan Sri Leo Mogi. and a copy to Professor Robert Fry Engle. Ladies and gentlemen, the Brand Laureate Coffee Table Book is a documentation of all the winning brands that has received the Brand Laureate Awards in 2007 and 2008. Thank you. Now I'd like to pass the, thank you, gentlemen. Thank you. I'd like to pass the mic now back to Puan Zuraimi.
Thank you, Ms. Chu. On behalf of UNITEN and Malaysians, I'd like to take this opportunity to congratulate Professor Robert Fry Engle III for being the proud recipient of the Brands Laureate Brands Personality Award. Distinguished guests, ladies and gentlemen, we have now concluded our lecture. On behalf of the organizing committee, we would like to thank Professor Robert Fry Engle III for his special presence and contribution to the event. We would also like to thank your kind cooperation throughout the event. For your information, the next Tun Mahathir lecture series will be held on the 8th of April 2009. The speaker is Professor George Fitzgerald Smoot, who is the director of the Berkeley Center for Cosmological Physics. He was awarded the 2006 Nobel Prize in Physics for the discovery of the black body form and anisotropy of the cosmic microwave background radiation. You're all cordially invited. Admission is free via online registration at www.uniten.edu.my. And here's a special announcement from the organizing committee. Ladies and gentlemen, before you leave, please complete the questionnaires given to you earlier and leave them on the chairs or pass them to our officers in the hall. Your cooperation and feedback will be most appreciated. Once again, thank you for your kind presence and support throughout the event.